Hello everyone and welcome back. In this video we are going to react to a great video from Khoo, 6 investment megatrends for explosive profits. The market right now is very volatile. You have stocks that are going up and up and up, and stocks that are getting hated, that are getting down and down and down. So how to spot opportunities in this market? What are the key trends that are important? This is what we are going to talk about in this video, and we will do so by reviewing the great Khoo. In case you don't know Khoo, please subscribe to his YouTube channel. He's a great teacher, a great mentor, and I think we can start. In case this is your first video from this YouTube channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And Khoo is a great inspiration to beat the market. So it's always helpful to watch his videos, and this is why I'm sharing the video with you today. So normally everything should work correctly.
Hi guys, so in this three-part video, I'm going to focus on what are the 6 most powerful investment megatrends that are poised to deliver double-digit gains in the next 10 to 20 years. Because once we know this, we know how to best position our portfolio to beat the market. Let's find out more. My investment portfolio has delivered over 260% return versus the S&P 500 that has delivered 170% return. This is despite going through a major recession, COVID-19 pandemic, 2 bear markets, and a very close bear market last year. And the key to doing this is, I keep saying, not just owning the highest quality businesses with the strongest economic moats, but even more importantly is to make sure that you invest in businesses that are in long-term growth trends, or we call them megatrends. So
yeah, this is also something that I preach on my YouTube channel. You want to be invested in companies within an industry that is growing. Don't invest in industries that are poised to decelerate or just die in the future. You want to invest in companies that are growing inside industries that are growing. It will give you a tailwind, and a rising tide will lift all boats.
So what are megatrends? These are trends driven by long-term structural changes. So we call them secular trends, which are different from cyclical trends, which are basically they go up and down with the business cycle. So these are multi-decade themes where demand and spending are likely to grow regardless of the short-term macro situation. The first investment megatrend is pretty obvious. You guessed it. I've been talking about this for the last 3 years. That's right. This is the AI and robotics megatrend. So why is this a long-term secular megatrend? Because as you know, AI, agentic AI, large language models are being embedded into every sector of the economy, embedded into manufacturing, healthcare, finance, logistics, energy, and defense. And all this drives structural productivity gains for all these businesses. And it's very sticky, high switching costs. Once companies integrate it, they're going to stick with it and they're going to grow it. And businesses are now forced to automate because of aging populations, labor shortages around the world, and of course, global competition. You have to embed AI in order to compete in the world right now. And the global AI market is projected to grow at 26 to 30% compounded annual growth rate, or CAGR, to at least 2033.
Yeah, this is like the internet back in the days 20 years ago. A new megatrend that is recent, only 3 years old, and it will drive the world in the future, and everything is accelerating. So yeah, AI for sure is a trend that will grow at least 20% per year for the foreseeable future. If you find opportunities in this AI trend, this is lovely. Now you see in the chart below, within AI stocks, you have a few sub-segments, so he will talk about this later.
Now, one of the most common questions obviously is, what are the best AI stocks to invest in? Now, AI stocks, again, is a very broad topic, but you can divide it into 2 types of AI stocks. You have got, first of all, what we call the AI enablers, and you've got the AI adopters. So AI enablers are companies that make AI possible, either by providing the infrastructure hardware or the infrastructure software and services. So in terms of infrastructure hardware, obviously the main ones would be the accelerated chips or the semiconductors, and those have done the best in the last 3 years. So for example, semiconductors like your Nvidia, your ASML, your Broadcom, your TSM. So are these semiconductor stocks already too expensive? Have they run too far? Is there any more growth left in them? Well, let's take a closer look. So if you take a look at, for example, Nvidia, you can see that the latest intrinsic value, you can check it out from Stock Oracle, is $215. And currently the share price after a slight pullback is now at 184. So it is actually slightly undervalued. And what is the projected growth rate moving forward? You can see for the next 3 to 5 years is still projected to grow at 31.96% a year. And beyond that is still projected to grow at 26.26%.
The growth rate for Nvidia is really crazy. Now the company has completely shifted out of gaming to be an AI play. Completely crazy. The company is growing so well, so nicely, that actually the valuation is not expensive. For the kind of growth they have, and as they keep delivering, the valuation is not crazy at all. What is really surprising is the amount of growth they have for a sustainable amount of time. 2023, 2024, 2025, 2026, it's already done. So the growth they have is immense. So the valuation is decreasing. The stock has become much more cheaper than in 2023, for example. I remember when we were talking about Nvidia, when I was working in Paris in an investment fund, people were completely delusional and crazy about Nvidia, about this super mega trend. Turns out they were right. People compared Nvidia to Cisco. Not a good comparison, because for Cisco and for the dot-com bubble, the stock prices went up immensely in 2000, for example, just before 2000, but the earnings didn't follow through. For Nvidia, the stock is going up a lot, but the earnings are going up a lot. So actually the valuation is really reasonable, maybe a little bit cheap given the growth. It's immense. Now the only question is, do you really want to invest in Nvidia? Do you really understand Nvidia? Do you really think they will grow to this level for the next 5 years? For me, I have no clue, so I'm not touching the stock.
So is there a lot of runway left? Yes, I believe so. Is it too expensive? I don't think so. Now, of course, having said that, if I were to want to buy it for the first time, would I just jump in with everything right now? No. All right. So the thing is, once I know it's a great business, I know the intrinsic value, I like to buy when there's a margin of safety. That means when the share price goes significantly below the intrinsic value after a wave down pattern. It has waved down to a level of support. So for example, let me show you one of my charts. And again, these are the charts which I teach my students to draw in our investment class. They learn that for every stock, they have to draw the intrinsic value, and below the intrinsic value they learn that they have to draw at least 4 support levels, and these are technical support levels, because remember that nothing goes up in a straight line. Nvidia will be high in the future, but it doesn't go up every day, every week, every month, even every year, right? Although it could be every year, I don't know, right? But it goes up in wave patterns. As you can see, wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. So every time it waves down, it will tend to bounce off a support level. And you can never predict which one, right? So in this case, for example, this kind of like bounced off the first support level. But if there's another wave down because of some macro development in the short term, it may wave down to the second support level and bounce back, or even wave down to the third or the fourth support level. So I've always got at least 4 support levels. And what are these support levels for? These are where I add share.
Let me just skip this because I don't do technicals.
It's actually done really well for me. Last year especially, it's still my portfolio. Nvidia is still my portfolio. These are my core portfolio holdings. And now ASML is now slightly overvalued. You can see the intrinsic value is about 871, and right now the share price is 1280. So this is now overvalued. So
I remember very well how bearish people were on ASML 1 year ago, a few quarters ago. Really funny how the sentiment is changing rapidly, very fast. So now if you have your own stock portfolio and maybe you own some stocks that are hated, don't worry. Maybe in 1 year the stock price will double and your stocks will be loved again. For ASML, people had so many doubts 1 year ago, and since then it has more than doubled. Crazy. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video.
Would I want to buy this right now? No. It's in fact gone up on a wave up, on a wait for a wave down below the intrinsic value, a margin of safety, then I'll add again, right? So it's having that discipline. Never chase the girl. After the girl has run away, don't chase. Always be cool, wait for the girl to run back to you when she's fearful. And something will always spook her in the markets. You can be certain of that. And you can see that for ASML, again, what's the growth rate? Next 3 to 5 years, still projected to grow at 21%. And beyond that, growing at 16.98%. By the way, these figures come from FactSet, which is the data provider of Stock Oracle. So give you the other example of ASML. Okay, so again, you can see, for example, that the intrinsic value is over there, and right now it has waved up. So never buy after wave up, never chase the girl, right? So you can see, so this is, a wave.
Yeah, interesting. I've never done this kind of analysis of wave up, wave down. Only buy when you have wave down. Don't chase wave up. Actually, if you look at my track record, I've bought things regardless of the wave up, wave down. Just you buy when it's cheap and you just sit tight. I've never believed in waves, wave up, wave down, technicals, all this stuff. I don't use it. Let me skip.
Broadcom, okay? How about Broadcom?
I mean, you see, he's talking about leaders. You don't need to invest in micro caps, small caps, mid caps. You can invest in big, mega caps, big, huge companies. ASML is a monopoly. It was there, sitting in front of you 1 year ago. If you understood the business model, if you wanted to own ASML, you could have bought ASML. Monopoly, and it's still a monopoly. The business model has not changed whatsoever. TSMC just increased their demand for ASML. So yeah, this is a cyclical industry, and ASML is a monopoly. So if the AI trend is going up nicely, ASML will thrive. This is the case right now.
Right now is it's slightly undervalued despite going up a lot in the last few years, because the earnings and the cash flow have gone up even more than the share price. All right, so you can see intrinsic value about 405, stock price 352, slightly undervalued, and projected to grow at 20.88% next 5 years. Beyond that, 24%. So again, you can see they've gone up a lot, but there's still a long runway left. Let's look at the last one, TSM, which I don't own this one. I own all the rest. And the only reason I don't own TSM is because of the Taiwan issue, right? Now that Trump is saying, I'm going to take Greenland, he's probably going to say, okay, you take Taiwan. And then, well, I don't know. I can't predict what's going to happen. But anyway, that's the only reason I don't own TSM. But as a company, it's a great business. It's a fantastic business. Okay, and TSM is overvalued. You can see intrinsic value 281, right now 331, overvalued, but still projected to grow at 22%.
Yeah, TSM is a company that is shocking the world right now. They are beating their estimates, beat the guidance, revenue, earnings. They reported earnings a few days ago. They shocked the world again. It seems like the music is loud for AI, and the music is getting louder. I see no cracks right now in this industry. So maybe it's not too late to get into this cheap wagon. Maybe not. I will not buy right now. I have actually trimmed some positions in this sector, but so far everything is accelerating smoothly. You just have to cross your fingers and hope that you are not next. Some people will buy just 1 month before the peak of the cycle. It's okay. It's life. You take your responsibility and you make an investment. For all the stocks in the semiconductor industry, actually, they are not buys right now. They are holds, or maybe you want to trim the position a little bit. But the stocks have gone up immensely. Everything has doubled. All the guidance provisions we have for the future years, the estimates are extremely bullish. The sentiment is extremely bullish. It seems like the peak of the cycle. It sounds like the peak of the cycle. It tastes like the peak of the cycle. So maybe it's the peak. Or maybe you have no cyclicality and you have a secular trend. If you're comfortable answering this question, be my guest. But I'm not comfortable answering this question of if this cyclical or is this secular. Same thing for memory companies, by the way. For these reasons, I'm out. But for some investors that are knowledgeable in this industry, you have a lot of work to do here. You have a lot of opportunities to find some investments that nobody's talking about yet. This is lovely.
Were these semiconductors that again are part of the infrastructure hardware that makes AI possible. But within infrastructure hardware, you also have got the other part, which is data centers and compute infrastructure. And again, there are many companies. For example, one of the companies is Digital Realty Trust, or DLR. Now, bear in mind, this is a REIT that owns a lot of the data centers in the US. You also have got Vertiv, ticker symbol VRT.
Great company, Vertiv, by the way.
This company makes the thermal management or cooling systems and power management systems within the data centers. And you've got Eaton, ticker symbol ETN. This company, they build the grid infrastructure that makes sure electricity flows safely, right, to power the data centers and so on and so forth. Now, personally, I do not own them individually, DLR, VRT, ETN, but I do own them within a ETF, which I'll talk about later on. In fact, I've shared in my previous video. And why do I not own them individually? Because I think that individually their economic moats are not that strong. So for me, I'll only buy an individual stock if it's got what I call a monopolistic edge in the market. It's got a very strong economic moat. I'll buy the stock. But if the company is growing, but I think the moat may not be that strong, or the financials are not that consistent, then I would rather buy it within an ETF so there's more diversification. All right. Okay. Now I'll show you some examples in a while. Now, within infrastructure hardware, you also have got what we call the power providers, the independent power producers, like for example, Constellation Energy, CEG. You got Vistra Corp, VST. You got Chemical, CCJ, which is a uranium company. But I'll talk more about that separately because that alone is a second mega trend, which is
he made a video. You can check on his YouTube channel about the power stocks, power companies, how bullish this is for the future, because energy will be, or already is, the bottleneck for AI. So it will be very interesting to follow these companies. Again, if this is inside your circle of competence. I have analyzed them. Actually, we have talked about some of them inside my coaching program. And it's definitely the too hard pile for me, so I'm not touching them. But they are very interesting to follow. They are signing a lot of deals with big hyperscalers. They have a lot of demand. And you clearly see the next bottleneck for AI. Like in the future, the energy needs, the electricity needs for more data centers in the future are huge. So obviously it's a tailwind. Obviously it will be a growing industry. The power trade is really interesting if you want to get some exposure.
It's what we call the AI, energy, and power megatrends. So let's take a closer look at those data center and compute infrastructure stocks I just talked about. The first one was DLR, which is Digital Realty Corp, which is a REIT. And again, you can see that it's got a narrow moat, which is not bad. But again, notice the difference. Notice that a lot of the companies I buy, they have got very, very strong financials. What do I mean by that, right? If you look at NVIDIA, you can see that in terms of predictability of the revenue and profits, very good.
It's an exemplary business, which you don't have for small power companies. You look at TSMC, ASML, We are talking about leading companies with a wide moat. So yeah, it's not the same as a rate, for example.
Generally, REITs, their moats are not as strong
Exactly.
as the normal monopolistic company, right? So, for example, if you look at their moat over here, you can see where their moat comes from. They've got a moat score of 6 out of 10. They are one of the largest global owners of data centers with a portfolio spanning over 300 facilities in more than 25 countries. Not that high pricing power, high barriers to entry, medium switching cost, high economies of scale, but low network effects. So it's a good business, but I wouldn't say it's like rock solid, super monopolistic, which is what I like, right? What's the other one again? The other one was, I think, Vertiv. Vertiv Holdings, that does the thermal management, the cooling systems, the power management in the data centers, right? Because remember, data centers are made of all these semiconductor chips, and if it's too hot, it will melt. So you need a cooling system. So this company builds like the air conditioning within the data center, right?
Yeah, and there was an alliance or some partnerships with big companies. I think it's with Amazon, but I have a doubt. Amazon, you have Vertiv. Amazon wanted to partner up with cooling systems. Yeah. AWS unveils custom cooling technology in July 2025. And actually, this is not something to compete with Vertiv, but it's actually complementary. So AWS is saying a bottleneck. Vertiv is a solution. They will most likely work together. And yeah, obviously it's a mega trend. As you need more data centers, you will see more demand for Vertiv.
And the growth is pretty good. You can see that they are growing at 25% in the next 5 years. Beyond that, 29.96%. Pretty good growth. And you can see that, again, it's not bad. The financials are quite strong. The only thing is their moat is not that strong, right? They don't have a moat. So what does that mean? That means that they could have high growth now, but in the long run, they could be more easily disrupted by competition. That's what no moat means. Easily disrupted by competition. So companies like that, I rather not buy the individual stock unless I'm doing a short-term trade. But if it's a long-term investment, then I'd rather buy them within an ETF. The other example I gave for compute infrastructure was Eaton, ticker symbol ETN. I don't own this individually as well, but it's a great company. But I own it within an ETF again. And again, it's a pretty good company. You can see that high predictability, high profitability, growth, not bad, medium.
ETN. I don't know this company. Eaton Corp, PLC. So, from Ireland, market cap of $100 billion, selling trucks, axe, powerhouse, industrial, electrical and industrial businesses. Fair enough. Okay, low margins because it's capital intensive. Let me check the revenue, the growth. For the past 10 years, revenue not growing. Revenue has dropped in 2020 and then recovered. Net income growing, especially since 2020. They have some debt, which is normal for this kind of business. And the free cash flow has done nothing, and then you wake up since 2020. Okay. And the business has gotten more efficient. So yeah, something really interesting since COVID. An AI beneficiary, but lack of track record. I mean, in case AI and the data center build out turns out to be cyclical and this is slowing down in the future, this business will just go back to average, revert to the mean. I don't like it.
Growth 12.8 to 11.47%. So roughly 12% growth in the long run. Moat, they've got a narrow moat, which is not bad. It's investable. Very strong balance sheet. But currently slightly overvalued. You can see intrinsic value 270, but now selling at 329. So this is currently a bit overvalued when it comes to Eaton, but it's a pretty good business. So again, last year, semiconductors did really well. Data centers and compute infrastructure did also not too bad. And you can see that power producers, which I'll talk about next, that has also now started to catch up. Now let's move on to the other part about enablers. Again, remember, enablers are companies that make AI possible. So we talked about the hardware part, the infrastructure part. Let's now look at the infrastructure, software, and services. So these are companies that provide the software that make AI possible. So for example, the cloud providers, the hyperscalers like your Microsoft, your Amazon, your Alphabet, your Meta, and Palantir. So in 2025, Palantir did really well, over 100% return. I still own Palantir, although I've sold quite a bit of it, but I still own a sizable position. And of course, I own the rest as well. What's interesting is that, Alphabet did really well. Google did really well in 2025, but Meta slightly underperformed. Microsoft underperformed, and Amazon, which is my biggest position, underperformed in 2025. But I believe in this year and next year and beyond, I think Amazon will be the next Alphabet, or will be the next Google. And what I mean by that is that it's been sleeping, but I think it's going to be one of the best performers in the next couple of years.
Yeah, if you look at Meta and Amazon, they are very well positioned to benefit from AI, because you can clearly see quite easily how they can implement AI everywhere in their business model. Same thing for Google, same thing for Microsoft. Microsoft, you can just put a bundle, call it Copilot, increase your prices, and call it a day. And you increase your prices every year with more AI implementation. That's fine. You can connect this to your laptop and have AI implemented everywhere. The implementation for the Magnificent Seven companies is really simple. For Google, you can connect Gemini to Gmail, to YouTube, to everything. For Facebook, you can have better ads. So everything is connected. Better targeting thanks to AI, because AI knows everything about you. You get the cookies from one company, selling to another company. You have better ads, better targeting. So advertisers will pay more to have this better data. I can see really easily how they can implement AI everywhere. And Amazon is everywhere. They have so many parts, moving parts. They can literally implement AI everywhere. And this is also the reason why Jeff Bezos is back. In an interview from 1 year ago, Jeff Bezos said that he was in retirement, but he saw the potential of AI, that AI could literally be implemented in every segment Amazon has. So he got out of retirement and he's back to working full-time in Amazon. So yeah, Jeff Bezos is back. He sees the potential. Really, really interesting to see how it goes on. For 2026, I suspect Meta Platforms and Amazon will have very good years.
Again, I could be wrong, but that's just my guess. I'll explain why later on. So they provide the software and services. So again, while this has been flying, this has been consolidating. But pretty soon this would start to take off again. It's a matter of time, right? And then you've got database companies like MongoDB, MDB, and Snowflake, SNOW. Now, I don't own any of these, but they've done pretty well in 2025. Then you've got design automation companies like Synopsys and Cadence Design, two very good companies, but I don't own them. And the only reason I don't own them is because I already have a lot of exposure to enablers. But if you ask me, would I buy them if I didn't have a lot of enablers? I wouldn't mind buying them because they're both very, very good companies, Synopsys and Cadence Design. And they are kind of like a duopoly in the design automation market. Next, enterprise software supporting AI workloads. The two main leaders in this area are Salesforce, ticker symbol CRM, and ServiceNow, ticker symbol NOW. They both significantly underperform in 2025. In fact, they're both down like over 20% in 2025 for different reasons. For Salesforce, the concern is that agentic AI may reduce their revenue because with agentic AI, companies need less employees, and because their pricing is based on the number of licenses, that could reduce the licenses because of less people, that could reduce the revenue. But Salesforce has already been pivoting to a consumption-based pricing model. So that means that even if their customers have less employees, less seats, But if each person uses more and more of their agentic AI platform, that can still grow their revenue and their profits, because again, it's a consumption-based pricing model and not a seat license-based pricing model.
Very good point. Very good point. All the SaaS companies are doing the same thing. They know that you will have a Jevons effect, which means fewer people might use your service. So how do you monetize for this? If one person can do the work of 10 people, maybe you want to charge 10 times more. Well, how can you do this? You do this with credits. Salesforce is doing this. You have ServiceNow that has released a premium tier. You have Adobe that is releasing credits also. And if you want AI to take over the world, every time you will use an AI service, you will have to pay as a form of credit. So the focus is no longer on seats, but it's on monetization. What is the best, the most amount of dollars you can get out of each customer? And we will see if it works out. It's so recent right now. It's too early to tell if the strategy will work out okay or it will be a complete fail. It's too early to tell. But we will see. 2026 will be the year of monetization, so we will see.
Now, for ServiceNow, the reason it dropped was a pretty stupid reason. It's because of they made the biggest acquisition into a cybersecurity company, Armis, for $7 billion, right? So personally, I think that these two stocks are very undervalued right now, and they are prime beneficiaries of the agentic AI growth moving ahead. So I think that once the market shifts back to software, I think that this has significant upside. So far in the first 3 years of the AI revolution, a lot of the money has gone into the enablers, specifically the hardware. But I believe that from now on, the hardware will still do well, but I think money will broaden to shift into the software infrastructure and into the adopters.
So Adam Khoo is calling for a pivotal moment, money flowing a little bit out of hardware towards software. Okay, Adam Khoo is, I hope he's calling the bottom for software companies, software stocks. We will see. But yeah, it seems like he's getting more and more interested in software companies that will implement AI. Chuck Acre and his team are saying the same thing. You have hardware and you have software. Either you produce a lot of capex, or you produce no capex at all, you are asset light and you use AI, like MSCI, for example, like the cybersecurity trade. Okay, so he's really increasingly bullish for this kind of investments. Interesting.
I think that this is where companies are undervalued, and I think this is where a lot of upside will be in the next year or so. So what are AI adopters? These are companies that do not make the AI. These are companies that use the AI to make their products either better or make their companies more efficient by lowering their costs and increasing their profit margins. So again, we can divide them into external product enhancement, where AI makes their product better, or AI makes their company more productive, improves their profit margins. So examples of external product enhancement with AI would be cybersecurity companies, like leaders like Palo Alto, PANW, Fortinet, FT&T, and CrowdStrike, CRWD. And these cybersecurity companies by themselves are within a long-term growth trend as well.
Yes.
Right, because of cyber risk and cybersecurity. They have underperformed in 2025, but I think that they will rebound this year and in the years to come. Next will be medical devices companies like Intuitive Surgical, which is a great company. The only thing is a bit too expensive. If it was cheaper, I'll buy it. Still waiting. And IT consulting, of which the leader is Accenture. So Accenture has underperformed in 2025, but the majority of their billings are now coming from AI consulting. So I think they're also one of the prime beneficiaries of AI.
Literally, they will implement AI everywhere. For cybersecurity companies, surgical robots, or all the consulting stuff, they will implement AI everywhere. They will need fewer employees to do the same amount of work, which means better efficiency, better cost control, better margins. All these businesses will see their margins improve. If they succeed in their AI implementation strategy, the margins will go up, profitability will go up.
But it's not been factored in yet to their share price. So I think there's a lot of upside in Ascension because, again, currently it is also very, very undervalued. Next will be companies that can use AI to become more efficient, growing their profit margins. Companies like Waste Management, which initially underperformed at the start of last year but started to rebound back. And I bought a pretty big position in Waste Management. Data providers like S&P Global, FactSet, MSCI underperformed last year. It's a matter of time they will rebound.
Yeah, the data providers have an edge here. They will not be disrupted because they have their own private data. So they can just implement AI, use AI to find something inside their big private ecosystem. So they really can't be copied by LLMs. They have their own proprietary data, and they have been having this private data for decades. You cannot create another MSCI. It's impossible. So they will just implement AI everywhere. And I know for MSCI, I know for S&P Global, they are doing it. And it is working for the moment. So actually, data providers are lowering costs. They are not hiring anymore. And at the same time, they are reaccelerating revenue thanks to AI. So far, it is working. For Salesforce, ServiceNow, it's too early to tell if AI will be monetized. For MSCI, it's already happening.
And of course, banks. Banks have done very well. Especially Singapore banks like DBS uses a lot of AI. In the US, you've got JP Morgan. And with AI, they would significantly increase their margins as well. So I think banks have, again, a lot of room to run. But bear in mind, as much as I love the banks, I think they are currently a bit overvalued and overextended in the short term. For example, if you look at DBS Bank, it's like wave up, wave down, wave up, wave down, wave up. Okay, I want to wait for wave down before I'll add more. I'll see you guys in part 2 and then part 3 of this video where I'll cover a lot more.
Okay, good megatrends. So the summary of this video is either you continue to believe in the hardware trade or you want to play the defensive trend. And Adam is calling for maybe a pivotal moment from hardware to software. Hardware companies will do great. As long as the AI trend is booming, hardware will be fine. But software companies are hated right now. So maybe they will benefit as much from AI, but the sentiment will change a lot. So these, and I agree with him, these are where the opportunities are. Stocks that are hated and companies that will benefit from AI. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a video, a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.